PNB Housing Finance reported a drop in its profit by 22% and its asset quality deteriorated, with gross NPAs inching up to 1.75% versus 0.84% on a sequential basis. So what went behind these earnings and what is the reason for this deterioration in the asset quality? The management of PNB Housing Finance is here with us to talk to us about it. Mr. Sanjaya Gupta. Sir, so what is the reason for this deterioration in this asset quality? I understand that two key accounts, Radius and Supertech, have slipped into the NPA category. So what more do you have to tell us about this?
So, on the deteriorating asset quality, Q3 always peaks up. So even on the retail front, the NPAs go up by about 20 to 22 basis points. And that is exactly what happened in the retail front also, because the SARFAESI action takes on an average 6 months time for resolution. And the SARFAESI in a financial year always starts in the month of May, June. And by the time it is December, the resolutions are ripe for, the accounts are ripe for resolution in Q4. So that happened on the retail front. On the corporate side, as we had said in the May earnings call too, we had 5 stressed accounts, out of which 1 went into NPA in Q2, which is IREO, and 2 more, which is Supertech and Radius, went into NPA in Q3, and hence the ECL provisioning saw a very sharp uptake in Q3. Because of the corporate book and because of the retail 25 basis points addition on the NPA side. And we are very sure that in Q4, both on retail and on corporate side, we are going to see some very healthy, resolutions, and the NPA figures will come down. The profit got impacted not because only of NPAs and the ECL provisioning, which we did in a very conservative fashion in Q3, but also from the fact that our capital raise has got delayed. It was supposed to be somewhere early Q3, which will happen in Q4 now. And we were carrying excess liquidity of in excess of 10,000 crores during Q3, which also compressed our NIIs. And we degrew on our disbursements, which impacted our non-fund based income in Q3, because we are staying away from under construction properties even on the retail side. And our under construction properties on the retail portfolio has come down over the last 1.5 years from 42% to 20%, because the flow of credit to the real estate developers is not happening, and there are limitations for retail customers to keep paying their installments when the homes are not getting delivered.
So what is the update on these 2 accounts? They have slipped into the NPA categories, Radius and Supertech. Any roadmap ahead, any prospects of recoveries, and what is the status currently?
So what in Supertech we have done is especially that we have created remoteness to NCLT with the help of Haryana RERA, and the project has moved into into an SPV where the shares are pledged with us along with the mortgage of the land. And we think that because it is last mile funding, the construction is about 85% complete. So we think that, we will get some risk capital into it. Only 70-75 crores is required to finish the properties. 75% of the project is sold, and there are huge amount of receivables from the sold inventory itself. So I think that should see some resolution. On the Radius Harbour Heights project, we think we will get some resolution between the 2 partners in the project, but I'm not very sure how it will fare out in Q4. But on the IREO front, I am very sure that in Q4 we are going to see some resolutions, because ever since Q2, when it moved into the NPA bucket, we have been working very closely with the promoters.
Okay. Sir, I also understand that few accounts have also slipped into the stage 2 asset category. So which accounts are these and how much is the total exposure?
Well, it will not be, proper on my side to be giving details, because I have to stay with the confidentiality of my clients. They are not too many, and let me tell you, this is business as usual. Accounts keep coming into stage 2, keep moving back into stage 1. That is a business, and I'm very sure that we will get them back into stage 1 during quarter 4. We have been speaking with these developers and monitoring the projects very closely.
Okay, so sir, going forward, so when do you see signs of bottoming out, if at all you do see any?
Well, I think the FY21 is going to be a year of resurgence in the real estate market. We are very keenly waiting for the budget and for the RBI to give us some window of relaxation or dispensation in restructuring the construction finance portfolio, because that is what the entire sector has been waiting for. So all the liquidity which has come back into the market at very reasonable cost can only get used if these accounts are allowed to be restructured.
Okay, sir, on the retail side, while you did say that in Q3 we do see asset quality issues spiking up, and there's an element of seasonality involved here, but can we say that for sure? Because we've seen retail asset quality issues erupt for many of the financial entities, and you think that going forward in next few quarters we can see more of retail asset quality issues considering the economic slowdown?
Well, I can speak for myself. Certainly quarter 4 is going to see a much better retail gross NPA figures. But at a sector level, I am very wary of under construction properties where the retail homeowners have bought and are servicing their installments, and the properties are getting delayed and the deliveries are not on schedule. And that can only happen if the flow of credit to the real estate segment starts during FY21.
Okay, so sir, you plan to raise funds in Q4. How much are you looking to raise? And in case, let's say the fundraising does not happen, there is an alternative out there, the government's AIF that the government had proposed. Are there any plans to make use of that as well and approach the government to avail some funding from that?
Well, our capital raise is mutually exclusive to AIF. I don't require AIF. We are not a construction company. I can only talk about our capital raise in the vicinity of 1500 to 1600 crores in this fiscal, which will be a growth capital for almost 30 to 36 months going forward. And the most positive thing which has happened is that PNB has reinstated its confidence in PNB Housing. They are going to stay at a minimum of 26%. There's going to be no secondary sale. The brand PNB is going to stay with PNB Housing. So it gives us a lot of confidence to rejig our business strategy going forward for at least 2 to 3 years. So I'm confident about ourselves. We are a retail franchisee. Today, 82% of our AUM is contributed by retail assets, and that shall grow to about 85% going forward, with an annual growth of anything between 15 to 16% CAGR for the next 3 years.
So what I actually meant to ask is, some of the developers who are attached to you for funding, in case they are facing further difficulties in completing their projects, would you be encouraging them to take that particular route, or in your knowledge are some of them already doing that?
Well, some of them have already approached, or most of them have already approached the AIF funding. But the big question mark is that the main lender cannot be giving away the rights of SURFACE and the fundamental right of mortgage of the property for the last mile funder. And that is why the restructuring window is a must to have for AIF or risk capital to come in to the real estate sector. Otherwise, the lenders are not going to give away the mortgage rights for the last mile funding. That's my individual feeling about it.
So one of the analysts actually pointed out that the pricing for your home loans is actually much on the higher side in comparison to peers. So you lose out on that competitive advantage. So are there any plans, or are you in a position to lower the rates from here on and go for go for a more aggressive growth?
Yeah, so you are bang on right. Q3 we saw a softening of our rates by about 25 to 30 bips, and already from 24th, which is today, our home loans are carrying much lower rates than what we were quoting previously.
Okay, Mr. Gupta, so one last question. So now this financial year is almost over. So what would FY21 look like? Do we expect a material improvement? You have articulated a plan to achieve certain ROAs and ROEs. How could you spell it out for our viewers as well?
Well, I think still 70 days are left, and that's the period of much action. So you will see far superior, I would say, both business and financial performance of the company. And as a sector also, I can tell you Q4 is very important. It's significantly important. And I think going forward from FY21, the retail focus and focus on affordable housing is going to be the mantra of the game. And we are very confident because our OPEX to ATA is compressing, our CIR is compressing, that we should be back into a ROTA regime of anywhere between, let's say, 160 to 165 basis points. The levers would be very conservative, starting from something like 6.5% going upwards to about 8%. From 6.5 times going upwards to about 8 times. So the ROEs and the return of equity should be somewhere between 14 to 15% going ahead.
Mr. Gupta, thank you so much for joining us, and I hope that you do achieve all the targets that you have laid out.
Thank you so much for having me over. Thanks a lot. Have a nice day.
Thank you, sir.